It's dangerous for an investor to underestimate the impact of technological disruption on the markets. We'll be talking about this with our next guest, David Barse. He is the CEO of XOUT Capital, and he focuses primarily on investing in those companies that are technological leaders in innovation. Welcome back to the show, David.
David, it's great to be here as always. Thank you again.
You are famous on our program for being a market bull. I mean, we don't see a lot of those these days, but you're adamantly bullish on the stock market. So that's worked out pretty well so far, except we've had this little glitch in the markets in the last couple of weeks, ever since the middle of September, shall we say. This morning, as well as we speak on Monday morning, the indices are down a little bit. Why do you think that is?
Well, look, I think the market has a very short-term memory. And this was the same issue that occurred in the first quarter of this year, where a slight uptick in Treasury yields seems to cause a deflation of everything that's innovative. And I just don't understand why the market's memory continues to forget that as companies report earnings and fundamentally show how they can continue to grow, even in what is a challenging environment. I think we can all agree that what COVID has done to the marketplace is going to take some time before it works itself back to normal. But the market seems to forget. So what's happened since the middle of September, as you picked the timeline, and today in an exacerbated way, is this just memory loss. And we'll see some earnings announcements that are going to be coming out over the next few weeks, and it will smack everybody right back into place. And I will continue to be an optimist about well-financed growth companies and how those are the ones that you should own, and leave it to a company like XOUT to get rid of or exclude, or in our parlance, X out the companies you don't want to own.
So you brought up several things now, David. I want to touch on yields first. So the 10-year yield, I'm looking at the chart right now, it's risen about 25 basis points since the end of August. And that has coincided with the decline of the stock market indices that we talked about. Do you think there's a correlation there? I mean, as a fund manager, aren't you concerned about rising yields? Doesn't that affect valuations at all?
I mean, I don't think I was born yesterday. And I would say that if anyone, and there are a lot of people who you bring on your show who I disagree with, there's no one who's going to disagree with the fact that interest rates are generally going to be moving in only one direction, right? Yields are going to continue to rise. They can't get any lower, so they got to rise. So these slightly upticks in yields over these periods of time, whether it was in the first quarter, remember, where'd the 10-year get to? I think 176 or something like that at its peak. That's We're still not back there yet. And it's shocking to me that the market acts like this is new information. There's nothing new about this. They're going to go only in one direction, and everyone should be prepared for that. And I think the companies, again, that we focus on are thinking forward, not backward, and anticipate that we're going to be back to a normalized rate environment, whatever that means, in the future.
So just to recap for the audience, for those people watching now who may not seen our prior interviews, your fund takes the broad index and you X out, so to speak, you eliminate those stocks that you deem are, in your words, loser stocks. And you have a model, you have a strict set of rules that you abide by, and those rules will tell you which companies will likely underperform or outperform based on those rules. So you've picked out, I read that list, we'll show that again on the screen here. You've picked out a number of stocks that you think are laggards according to your metrics. Now, you talked to me earlier about technological disruption. So in some sense, you're kind of a futurist. And when I like, we like that about you. You kind of look at how the world's going to be in the future, and then you eliminate those stocks that you think are not going to keep up with the pace of growth towards that future, right? So let me just ask you this. What do you think the future is going to look like in 10, 15 years? What do you think society, what do you think our economy is going to look like? What kind of technologies are going to use? What do companies need to do now to prepare for that vision of your future?
How about this? It's going to look different.
Yeah.
And I'd say to you that the beauty is no one has a true crystal ball for how it's going to look and how our behavior is going to change. And what has to happen to alter our behavior is unforeseen disruption events. So I'd posit that the pandemic that COVID-19 brought on changed our behavior. It was unforeseen. No one predicted this would happen. But now all of a sudden, hybrid work environments are accepted. When I ran my company, if someone told me they wanted to dial in for a meeting, they'd last for a week, maybe a month, but they'd be gone because they had to come into the office to work. Now, that is not the norm any longer. Right now, it's okay, right? We're seeing hybrid environments change across the globe. And even in New York City, the center of finance around the globe, you're seeing companies all for different work environments, right? Different paradigms are coming out of this. So that's a change in behavior, right? Who's to predict how long that will last? I'll tell you, it's probably a permanent change right now. And I think we will adjust ourselves. So that's one thing that people should stay focused on. How does that impact the way in which we conduct commerce on a go-forward basis? And who are going to be the winners and who are going to be the losers? I tell you, it's easier to figure out how to exclude the companies that are likely to get impacted by something like that on a permanent or semi-permanent basis than it will be to pick the winners.
Brought up an interesting question to me offline, which is, what do you think the S&P 500 is going to look like in the future? And I thought that was a very, very good question. Very, very important thing that investors should be wondering right now. I'm looking at your fund, for example. Your top fund holdings are Apple, Microsoft. We'll talk about the XOUT part in a bit, but your top fund holdings, Apple, Amazon, Microsoft, Alphabet, so Google, Facebook, Visa, Nvidia, Johnson & Johnson, Walmart, and other things. But most of those in the top 10 list, I notice, are tech companies. But like you rightly pointed out before to me, you're not a tech fund. You're picking the biggest companies of the S&P 500. And it just so happens to be that a lot of these things are tech companies. Is that the way of the future?
Well, look, I think the interesting education is take that top 10 list from 10 years ago, and you'd be surprised at the names that were on that list that are not on that list today. And I would posit to you that 10 years from now, the names that are on this list today may not be there in 10 years from now. I have said many times to you that technological disruption is impacting all companies in all industries. It's not just a technology phenomena. So those 10 companies that are currently on the list, whether it be Facebook or Tesla, which isn't on our list right now, but these are companies that could get disrupted themselves from innovation. And no one really knows right now, but we know that the forward-facing risk that technology change has on companies is going to impact them. And so I find it fascinating to talk to most people, and everyone focuses on history, and no one's thinking about the future. And many of these companies are preparing themselves for the future, and we just don't know who the next winners, who are the next Googles and Apples and Amazons that are likely to emerge. And will those companies end up rising to the level of being top 10 companies? I don't know, but I think our job is to just figure out what not to own. And it's so much easier to do that.
Those companies that used to be in the 500 largest companies club, I want to call it a little club, and they're no longer in that club, what do those companies have in common?
Failure to adapt. They have a product that let's pick on the energy, oil, and gas industry, right? Exxon and Chevron were perennial top 10 S&P 500 companies, and they are just dealing with a product now that is something that's going to, even though current commodity prices are saying something otherwise, the supply-demand dynamic on a long-term basis is going to neutralize itself, right? They just won't have demand for that product. What we're seeing being announced, and the activists who are involved in Exxon trying to change them and trying to reorient the company towards making investments for the future, I just think it's too little too late. And so that's why that company is not likely to get back on our top 10 list again.
It's hard to imagine, actually, right now as we speak. Of course, anything can happen, but it's hard to imagine Google being the next IBM in a metaphorical sense. I mean, people have told me that it's kind of difficult to to overthrow the throne that these tech companies have built, the moat that they've built around themselves, if a tech company, an emerging tech company, were to disrupt the industry, so to speak, wouldn't they just get bought out?
Yeah, look, I don't disagree with you. The moats are huge, but the risk that I think the number one risk that these companies face on a forward-looking basis is not just the disruption that comes from their own peers or potential peers, it's the regulatory environment. And we all know that there's a lot of change going on in leaders in governments all across the globe and how they view the risk of the dominance of some of these mega tech companies has on things beyond just the technology space, right? So we're talking about, all the issues that these companies can potentially engage in terms of other economic activity. And so regulatory environment is probably the number one risk. And we watch that each and every quarter. And if it's possible, right, that could be the disruption that people are not anticipating right now.
But if you have a fund mandate of from XOUT Capital, if you have a fund mandate to invest in the large caps, won't you miss out on some of the opportunities from the mid and small caps? Those are the guys that are going to disrupt the industry.
No, those are, again, we're trying to address one of the flaws of indexing. In an index, you buy everything. So we've attacked the large cap US equity space first. We're looking and studying how to attack the mid cap space, and then subsequently how to attack the small cap space, and then move off the US border into international markets and try to attack that space, because we think all of these indices are fundamentally flawed, and it is easier to just figure out what not to own than what to own and let the winners take care of themselves. So I agree with you. Small cap, mid cap is a great opportunity zone, if you will, for investing, but we're going to do that in a separate vehicle because I think that space is ripe for disruption as well.
All right. X'd out stocks: Tesla, JP Morgan, MasterCard, Procter & Gamble, Bank of America, Walt Disney, ExxonMobil, Netflix, Coca-Cola, Verizon. So we talked last quarter. You haven't changed your holdings or your X'd out stocks yet, but you will rebalance later this month, actually. The 21st of October will be your third quarter rebalancing date. What's going to change? Can you give us a teaser?
I don't know, but I can tell you, and I've said this, that I think a company like Tesla, which surprised us that it didn't score well in our model. Remember, we are a rules-based methodology, relying on 7 fundamental factors that we score. We have a proprietary weighting system for how we score them, and it kicks out the score, and the 250 worst scores get kicked out or X'd out, and the remaining 250 companies are left in the portfolio. Tesla just came in below the midline for its score, and as a result, it didn't make the grade. I was surprised. Our model is going to, as it does every quarter, reevaluates, and I would suspect that if you wanted a little teaser, this is pure conjecture, but I would suspect that a company like Tesla, which got eliminated primarily because it decelerated its growth rate. I think Elon Musk was aware of that, and this is why just yesterday or over the weekend they announced how many cars they sold for just 1 month. I think he's starting to indicate to the market themselves. There's your teaser, if you will, that they produced more cars in 1 month. And I think in an environment where a lot of folks believe they're a company that's going to get severely impacted by the supply chain challenges that are going on in the marketplace because of their reliance on semiconductor chips. I think he's telling everybody, we figured that out. We're smarter than everyone. We're not going to get disrupted any longer. And so there's your teaser.
I want to talk about your model for just a bit now. I know you have a rules-based methodology, but when a stock like Tesla continues to grow in terms of its valuations and its price, do you think to yourself, maybe we should reevaluate some aspects of this model, or maybe we can make an exception for the stock? Maybe Tesla has scored poorly, using the metrics on this model, but if the stock continues to perform because of sentiment, because of hype, or whatever reason, would you make an exception, is my question?
Yeah, I mean, I wish I was that smart, David. I don't think I am. Probably your viewers mostly think that about me already, but I would tell you that the reality is human beings who are in the asset manager business, who are stock pickers or security pickers, if you want to be more broader, those who are successful at making a good decision about when to own, when to sell, and when to buy is a rare breed. It's a very select few that are good at that. And I learned after a long career of being in the stock picking business that it's really hard to do that well and do it consistently. So what did that learning translate into? XOUT, a rules-based methodology where all of the work that we did, all of the brain science went into the preparation of that rule. And once the rule was put in place, I will never override it because I learned a very valuable lesson that it's really hard to beat the market over time. So making that exception decision would be one of those decisions that I'm sure if I made the exception, it would be wrong at the wrong time and hurt our performance. And I think that's why we've done so much better than the S&P.
Yeah, I noticed you don't have a lot of brick and mortar stores in your holdings, so that partly explains, well, it is explained by your thesis just now. All right, well, we'll talk more about how you pick the laggards next time after you rebalance your portfolio. We've talked about this a lot, so I want to see how your portfolio changes again, and we'll talk about that next time and discuss why you think those new XOUT companies are losers in your mind. So for now,
let me just make one last point to you. This is not about day-to-day, week-to-week, month-to-month, or quarter-to-quarter. This is about long-term secular decline. So we might make rebalancing decisions like a Tesla, where one quarter they come out and then another quarter they go back in. Really, the more meaningful illustration is, again, if you put that list of the top 10 names from 10 years ago, I bet you a lot of people will be like, wow, I can't believe those were the top 10 companies of the S&P 10 years ago. Only 2 of them are left today. I mean, isn't that fascinating? So I think that's what this is really about. So technological disruptions here to stay. It's the most important forward-facing risk we all have to deal with. Let's see what will happen next quarter. But I think much more interesting will be what's going to happen 10 years from now.
All right, excellent. And finally, you are rated 5 stars by the CFRA. Tell us about that. What's that rating based on?
Yeah, so they're a research firm, a very well-respected research firm in the ETF space that evaluates all ETFs, and they have only recently, just last week, came out with a report giving 5 stars. I'm not sure exactly what the metrics are that gives one ETF 5 stars and another ETF 1 star. In our case, they believe, as they can tell from the statistics, right, that our portfolio has requisite diversification, and as illustrated, even though in a short period of time, only 2 years, we're just about 2 years old, it has materially outperformed an index like the S&P 500. Mm-hmm. And as a result of that performance, we have received 5 stars.
Yeah, and I'm noticing on your fact sheet here, since inception, the XOUT index was up 33%, while the S&P 500 was up 26.7%. So performance by quite a bit of a margin. Now, congratulations once again, and I look forward to speaking with you after your rebalance in quarter 3. Thank you.
Great. Thanks, David. Great to be here.
Great to have you as always. And thank you for watching Kitco News. And don't forget to subscribe to our YouTube channel. I'm David Lin.